Hi there, Robert Wolf here with Terra Firma Business and Financial Consultants. I'm an asset coach and a tax strategist. So welcome again to another video, and we're going through. You'll find this series of just quick little videos talking about economic issues that are pertaining to what we call economic termites, and those economic termites are taxes, inflation, time, laws and regulations, and debt. And each of these videos are going to talk about how these different termites, so to speak, are affecting your wealth, your ability to grow your wealth, and quite honestly, things that are affecting the economy, which are pretty, as we're starting to see, starting to get very interesting. So to speak. So today's video is talking about an article that I received from one of my insurance companies talking about inflationary pressures. So I wanted to go through it. It's a lot more positive slant than what previous video that I showed with regards to a couple articles on Yahoo Finance, where the focus was how inflation was not the reason why unemployment numbers or higher numbers, employment numbers were lower than expected. It was a very negative slant, not a surprise. But this one seems a little more unbiased, so to speak, and it takes a little better positive slant to it, so to speak, because it's not so in your face negative and trying to create news, so to speak. So I'm going to minimize my picture over here. Okay, so this was as of June 7th, the article was, and it says, last week unemployment reports enabled stocks to rally towards record highs as new jobs created during the month of May amounted to 559,000 versus an expectation of 650,000. The unemployment rate also fell to 5.8%, which is great, which is what they expected to be what? 5.9. So they're expecting a higher inflation percentage, and it actually dropped. That's good. So even though they didn't get higher hires, the unemployment rate did drop. The solid pickup in employment, while not overheating in terms of jobs or wages, provided a supportive environment for markets to rally. Additionally, it at least temporarily eased concerns about the overheating economy. Now, this is not taken into consideration the other article and video that I spoke about regarding Janet Yellen, and talking about how adding the bonds of, I think it was like $14 billion in bonds or something to that effect. I don't remember the exact one. Go back to the other video and check that out. Where it wasn't going to over liquidify the economy, so to speak. It wasn't a big deal to add more liquidity to the market. She didn't think it was going to be a big deal to inflation. Now she's a much smarter person than I am, but I think from common sense and my BS meters kind of going off, ringing ding ding ding, because I think it's a little bit if I'm talking to banks and I'm talking to various people and banks are telling me they have a liquidity problem, what that means is that they have too much cash. Okay, they can't get rid of their cash enough, and that's because of the government. Right? It's the Federal Reserve, and so if the Federal Reserve is going to be selling bonds, that's more liquidity into the to the market. So, anyway, so I thought this week's inflation data will likely be bigger test after April's 0.08 increase, which was the largest since 2009. Think about that. Since after the Great Recession, right? 2009. This is when we had 2007, October 2007, the market started to decline. We had the financial crisis, so to speak, the real estate bubble bursted, right? And then in March of 2009 is when that 53% decrease in the S&P 500 started to uptick. Okay, so that's when the Fed started buying back mortgage debts, right? The Fed started bailing out insurance and finance and banks, so to speak. We saw a lot of bankruptcies with financial companies, bond companies, and so it would make sense with interest rates dropping as much as they did, the amount of liquidity that's when they started creating what they call quantitative easing. Okay, where the Fed starts buying debts, U.S. debts, to put money into the markets and remove the debts out of the markets. So it was a pretty big deal at that point, and so which makes sense why in 2009 we started to see a little rise. The expectation is for a 0.4%, so a double increase of what the expectation that would bring the year-over-year inflation rate to 4.7. Okay, the Fed's goal is 2%. Okay, and so with inflations being as low as they have, I mean, with the interest rates being as low as they have been, with the economy doing what it's been doing, as all these different functions of the economy before COVID, the pandemic, we were below 2%, the Fed's goal. Okay, now, surprisingly enough, we're double the Fed's goal, and the markets are concerned about inflationary pressures as any long-term uptick would erode the value of financial assets and put pressure on the Federal Reserve to deduct monetary accommodation. What's that mean? Stop putting money into the system. Okay, but they are doing it this month. Okay, and that's what the article with Janet Yellen said. Hey, it's okay. Okay, so check out in the link below. We're gonna add a link to that video that talks about that article about Janet Yellen. We'll have some information in there as well. The consensus expectation is for the rise in inflation to be temporary, but the bond market will be cautious given the amount of stimulus in the economy. Okay, so I don't know, quite honestly, I don't know why the consensus expectation in the rise in inflation is going to be temporary, because we've had basically 10 years where we've had quantitative easing, we've had a strong economy, then all of a sudden the world economy drops. The United States puts $4 trillion into the economy, whether it's reduced taxes, stop paying student loans, stop paying whatever, and then also stimulus dollars and checks going out to people. Unemployment numbers are high because guess what? The unemployment dollars to claim unemployment, those dollars are higher, $300, $600 more than normal on a weekly basis. So you have people not going to work. Right, and so now you have people who are historically not aggressive savers, where they have more money. They're not working in the system, but what they do is they have cash. So what they're doing is spending money into the system, and they're causing that demand to be greater. But they're not in the system to support the demand by working those jobs to help the supply chains. So that's, so all of a sudden we have this world economy shut down, and now the government, how can you say this is temporary? Where in anything, and I'm not just talking about this particular article, just in common sense, where do you think that anywhere this is going to be okay? With this much money going into the market and this much money going to the economy. Okay? When you already had tech giants with billions and billions and billions of dollars in cash sitting in their banks. Okay? Which is why they started these buyback programs back in the 2010 period. Okay? So, anyway, I expect peak inflation pressures to occur over the summer, yes, but how quickly it returns to a level closer to the Fed's 2% target will significantly impact asset prices towards the end of the year. Well, and part of this equation is also Biden's goal, Biden's dictate of how he's going to be taxing those that have these types of assets. He's increasing the taxes. So what's going to happen? You're putting people in a position that have money, and they've developed financial plans, and they have assets doing certain things based on the tax, based on inflation, based on all these other economic indicators, and all of a sudden all of that is being flipped upside down. Okay? And so what do you expect those people are going to do? Right? And that's my biggest concern about. And that's an unknown, right? We don't know what's going to happen with that. But when you have these pressures with the liquidity and too much money in the system from the Fed, from stimulus packages, from now people going back to work, and people who haven't spent for a year, people not working, people getting more money for not working. Right? And so you take all these things, and then taxes are going up, and then you have people like Warren Buffett saying that people are okay with the increase in prices. We're not okay with inflation. We're not okay with the increase in prices. Companies raise prices, and we're stuck with that. We have to put food on the table, right? We have to put gas in the cars to go to work or to do the things that we need to do on a day-to-day basis, right? We have to still spend money to live whatever lifestyle and to survive whatever we're doing has to be done. So I'm having some issues. So I apologize for my rant, but the reality is that you and I as small business owners are being affected by this. Okay, and that's why the major economic term I talk about in my book, and we talk about in our practice, is laws and regulations. When you have the people who make the laws can pass laws and make laws with really out our input, yes, we vote them in, but the consequences we are affected by. And all these decisions that have been had, okay, whether no matter what your thoughts are with the political situation, the bottom line is the reality is things are changing, and the cost of doing business is skyrocketing. The taxation of profit is skyrocketing. So, which is why you need to talk to professionals like us and other professionals to figure out, how do you mitigate this? How do you plan for this? Even if it's a short or long-term period, you need to start having those conversations. So thanks for joining us. If you like this, go to hit the like button. If you haven't subscribed yet, go ahead and subscribe. Hit the little bell so you get notifications when we do updates. We do updates periodically. We also add a bunch of other videos based on some of the planning ideas and strategies and that sort of stuff. So this channel is really to kind of talk about assets in general. Okay, and then how do we handle assets and all the pressures according to the economic termites I listed out earlier, pressure those assets that we have. Okay, so basically, how do you grow your wealth in this type of environment? And so that's what we're here to help for. So just basic common sense conversations is what we're looking for. So we're not looking to talk below you, talk over you, talk around you. We want to talk to you. So thanks for joining us, and look forward to that next time we get to chat and provide another video for you. Thanks so much. Have a great one.